Hello and welcome to a Alpha educational video where we break down the 60-40 portfolio and
the 4% rule.
That's right, everybody. So buckle up in for another thrilling conversation about finances and money.
Amen. Amen. Should we dive right in?
Yeah. I think why would we want to have a video explaining the 60-40 portfolio and the 4% rule? Let's start with the why. I read a book once. You should always start.
Yeah, we'll start with the why and a little bit of the what as well, because I think this is something that most people are pretty familiar with at this point. Like it's kind of, I guess, what a lot of people view as the retirement standard,
right?
Pulling 4% in perpetuity in the retirement. But I'll let you kind of give a high level overview of how it works. And
yeah. So going with the why first, right? So this is the standard. This is the methodology by which the majority of all financial advisors and do-it-yourselfers all model and follow, wouldn't you say?
Yeah.
And so quite simply, the 60-40 portfolio is just 60% in, and there's a lot of words that mean the same thing here, but I want to use them all. So you have, on one side of the table, you have growth, which is stock, which is ownership, which is equity. Okay, so you think you buy some shares in Apple or NVIDIA, that's your growth bucket. And then you have on the other side of the bucket, you have bonds. Bonds are debt. They're income instruments. Why are they income instruments? Because there's a yield, right? When you loan somebody money, they owe you an interest payment. That interest payment is income. And so you have bonds, you have debt, you have income. A lot of people refer to them as, would be the opposite of gross, safe. I mean, the opposite is gross income, but people view bonds as safer, right?
Yeah.
Depending on if, as long as you're not buying junk bonds.
Yeah.
And so somewhere along the way, this idea of having this portfolio with a half-ish in one and half-ish in the other is supposed to balance itself out. So if you think of a teeter-totter and you stack growth, equity, stock on one end and bonds, income, and debt on the other, it's supposed to act as a balance beam. It's supposed to balance each other out, right? So when one goes up, the other generally goes down. When it goes, and vice versa. So pretty much everybody's adopted this. And then in the 90s, they layered on the 4% rule on top of it.
Yep.
Do you think it was used much before the 4% rule came around? Would have had to be, right?
Yeah, I think the idea of having, because people see that as, diversification, but yeah. I think the idea of 60-40 might come into a position where it's maybe a little too rigid.
Yeah. And obviously, like, depending on your age, depending on the amount of income you need, and depending on your longevity and some other things and your risk tolerance levels, that could be 60% in bonds and 40% in stock.
Yeah.
It could be 3% if you're going to retire at 60. It could be 5% if you're not retiring until 70.
Yeah.
So there's a couple different things that can be tweaked or adjusted within here. But you may have noticed, and the reason why we want to do this video is you may have noticed articles that say things like the 60-40 portfolio is dead. That really popped up a lot in 2022, which was the 60-40 portfolio's worst year ever. And then you may have seen people talk about the 4% rule not necessarily being the safest thing in the world. And if you haven't seen it in articles, you've definitely heard it from me because I've been saying it for as long as I've been in this industry, probably.
Yeah, and you kind of hinted at the 90s, kind of when this became such a popular idea. You kind of want to go over the environment back in the 90s that made this so popular?
Yeah. So in 78, you had the introduction of the 401k. First one was introduced in 79. And then between 1980 and 2000, you had a huge shift occur in America. And it impacted our language and the way we think about this stuff. And so we went from defined benefit plans where you get a pension that provides you income to a defined contribution plan or a 401k, which accumulates a bucket of money, right? And so if you think about who was entering the workforce in the early 80s, it's the baby boomer generation. Well, by the mid 90s, you had enough people having entered this and having gone to a 401k that a question started to get asked. And that question was, it was like a reversal in thought. right? We went from pensions or income to this bucket of cash, and now we had to go from this bucket of cash back to income. So what does this bucket of money, my $500,000 or $1 million in my 401k, what does that mean to me in terms of income again? And so that's when there's 2 studies. William Bengen did one, and then 3 universities joined together. It's called the Trinity Study. And they both occurred about the same time, 93, 94. And William Bengen found that, if you took 4% per year adjusted for inflation out of a 60-40 portfolio, you'd never run out of money.
Sounds great.
Sounds great, right? Now, his study, caveats here, his study did take into account like 100 years of data. And I'm not going to get too much into it, but I'm curious as to how, one thing I'd love to research sometimes is how the markets and bonds performed when we were still on the gold standard to post when we went off of it. But without going down too many rabbit holes, basically you had this period of time where you had high bond yields and high market performance. And a lot of people felt that probably skewed the data. And then something happened in 2000, right? So from 2000 to 2010 was the first time ever that the stock market averaged a negative return. It's called the lost decade. And it was an average of negative 1% per year for 10 straight years. And that had never happened before. And so I think that probably had something to do. And then to get us out of the housing crisis, what happened to interest rates?
They dropped them.
Yeah, they're like nothing, right?
For a long time, yeah.
Yeah. Did you ever hear about Europe instituting negative interest rates?
Oh, yeah.
Yeah.
Which is kind of mind-boggling to think about.
Yes. We're going to charge you to keep your money.
Yeah. You give them their money and they take it. And it's just like.
Yeah. Made no sense to me.
Yeah.
And so somewhere around 2013 is when Wade Pfau and a team of researchers re-examined the 4% rule. And what they found is that if you had a 5-year period of low bond yields, low interest rate environment, it would create a 57% chance of someone taking 4% per year out of their 60-40 portfolio. It would create a 57% chance of failure. Is that a good summary?
Yeah. It was like based off the market environment back in 2013. I think it was trailing 5 years. And that kind of puts it in perspective compared to 80s and 90s when everything was going so well. You could probably retire just fine like that.
Well, we use an example where 2 people retire, both with $1 million, both taking 4%. And one retires in 1990, one retires in 2000. So obviously one is retired at the best possible time ever. One is retired at the worst possible time ever. But it's a $2 million swing in the net value of their portfolio. And our point is you don't want to be the person in the 90s any more than you want to be the person in 2000s.
Yeah, because
it's a coin toss.
Yeah, exactly. It comes down to luck because you don't really see the future coming. Or else everybody would just be rich if they knew when markets were going to be in a downturn versus a bull market like that.
Absolutely.
And Wade Pfau's findings were in a period of time where interest rates were quite low, causing that failure rate to go up. But conditions could have been even worse. And so they could have been worse, like in 2022, like you're talking about. And all of a sudden, maybe the failure rate is higher than 57%.
Yeah. It could go higher and it could be less. And so we've figured out, right, the number one best solution is just give us all your money and let us put you in an annuity, right?
That's one way to do
it. Mama needs new shoes. No, there's nothing wrong with annuities or anything like that. We have plenty of clients with annuities. I was just making an annuity joke.
But I think our overall point is just the fact that you don't want to leave your retirement up to luck.
Yeah, heck no. Do you really want your outcome to be dependent on something as random as just whatever the market and the bond market happens to do the year you go into retirement?
Yeah.
That's terrifying to me.
Yeah, because especially early on in retirement, like the sequence of returns that you're getting can make a huge impact.
Yeah.
Huge impact, good or bad.
Oh, absolutely. And I always tell people when they move money over to us, just so you know, the market's going to do one of 2 things. It's either going up or it's going down. And I had nothing to do with either one.
Yeah.
So exactly. Don't give me the credit when it goes up because I don't want the liability when it goes down either, right?
Yeah.
And you got to look at it a longer period of time than just the 6 months after we do something, right? But it is those first 3 years that are most dangerous for somebody entering retirement in regards to that sequence of equity rate of return risk.
Yeah.
And there's 4 major risks that impact you in retirement. The first 3 are sequence risks: sequence of equity rate of return, which is just the order of your gains and losses in the market; sequence of bond yield, order in which bonds produce high or low yields; and then sequence of inflation, which for the longest time we didn't ever have to worry about.
Yeah.
And then we did.
Yeah, it's been a little bit different in the 2020s here.
Yeah. Yeah. And then the kicker that compounds everything is your longevity. And it's a pretty staggering statistic as to, if you look at a married couple who's 60 years old today, the odds of one of them making it to 100.
Much higher than they used to be.
Oh, yeah.
So naturally, we're going to need more money.
Yeah, it's all that genetically modified food that we're ingesting and all the food dyes. It's just
it's making us stronger.
You just can't die anymore.
Yeah.
If RFK hears me, this was a joke.
Yeah, we're going to get canceled.
Yeah.
So contrasting the idea of 60-40, 4% rule, we kind of look at things more in terms of time horizon.
Yeah, right. This is something I was taught early on, and I just think it's super smart. And as you've pointed out, it's not that we're removing asset allocation or not doing asset allocation. It's just we're adding another layer on top of it, and we call that layer asset designation. And we're just designating a portion of your assets for a particular period of time. And when you know the period of time in which they're to be used, it gives you insight into how they should be invested and when changes should be made, right? And so we call it a wheel of time or the Alphi flow system. It's, whatever. But the point's just that you have this first bucket, and we already alluded to this, the most crucial few years, which is those first few years of retirement. And so if you need money to live off of, and that's a critical period of time, what do you think that should be invested in?
Something like cash.
Exactly. Cash or cash equivalents, right? You cannot afford to be drawing down out of an asset while it's getting its butt kicked in the market, right? Just imagine if this year, right, we're only in March, and what has the stock market been doing?
Not a whole lot up and down, but
whole lot of up and down. And imagine if every time you took an income draw off of that, you didn't know if it was up or down.
Yeah.
Or halfway up or halfway down.
Yeah.
There's a Scout song somewhere there.
I think so.
There really is. It's neither halfway up or halfway down. But and so it's just, you want this bucket of money you're drawing from to not be impacted by those things. Because if you take a 10% loss in the market and then you pull 4% out, well, now you're down 14. You're not down 10 anymore. And so it just starts to make things more difficult for you.
Yeah.
Yeah. So it's just because of the idea of having to draw income off of assets that are losing and how bad that can impact your portfolio, it's very important that those first few years you have that bucket of cash or cash equivalents with which to draw your income from. And then bucket 2. If I know I don't have to touch an asset for the first 3 years of my retirement, how could I have that bucket invested?
Definitely something a little bit more aggressive than just cash.
Oh, absolutely, right? And so that might be a more moderate bucket, right? And then I have my third bucket. Now this bucket, the second bucket's yours for 4 to 10. And then I have another bucket, my third bucket, which is for years 11 and on. And that's my growth bucket. Those are the sales that really power your financial voyage, your journey of retirement, right? And if I know I don't have to touch those for a decade, I mean, you would have fully recovered. You could have done nothing to protect your portfolio and fully recovered from 2000, 2001. You could have done nothing and fully recovered from 2008. Like 2 of the worst financial crises that ever happened. You could have literally done nothing to mitigate those losses at any point and fully recovered from them with that bucket.
Yeah.
Right? And then you have a fourth bucket, and that's your legacy bucket. Some people call it their leave-on money or whatever. And I always found this funny, right? I see a lot of clients that actually have accounts designated. They have no intention of ever touching them. They're probably never going to need to touch them. They know they're going to pass them on to their kids. And how do you think they have that money invested?
Probably not aggressive enough.
Yeah, I mean, they haven't invested just as if it was for them for their retirement. They're getting 4 to 6% on it or something. And I'm just sitting here. I'm like, you know what? How old's your child, right? How old's the person you're going to pass this money on to? If this money's for them, and maybe you don't invest it all the way to mimic them because there is some risk that you might end up needing it. But we've already talked about you got 1 to 3 covered, 4 to 10 covered, this huge bucket for 10 and on. Before all that would have to go away before you touch that money.
Yeah.
So it's just things for people to think about, right? As they're structuring their portfolio. And then within those buckets, you obviously still do your normal asset allocation and diversification, all that kind of stuff.
Yeah. So when, let's say during a downturn or something, you start drawing from the cash bucket, how do we kind of reallocate from one bucket to another?
Oh, yeah. This is one of my favorite parts of it, right? And that's just when you do your monthly rebalances. And I'm going to give you 2 different ways to do it. So if I'm feeding $10,000 a month out of my cash bucket to supplement my Social Security, I just move $10,000 out of my moderate bucket to my cash bucket and $10,000 from my growth bucket to my moderate bucket. And this also, speaking of twos, does 2 really cool things. One, I'm keeping my cash at that 2 or 3 year or 1 year mark, whatever I decided I needed based on my income needs and risk tolerances and that stuff. And then 2, I'm de-risking my portfolio. I'm capturing growth and I'm bumping it down a rung in regards to risk. And that's always going to be doing.
Yeah.
Now, the second way to do it is instead of monthly, you just monitor the market and maybe once every 3 to 6 months or so, you just sell off a portion of those other 2 buckets and transfer it over. You can do it either way. I mean, that's the great thing about this is even within this framework, there's still room for you to maneuver and do it the way that you are comfortable and like doing.
Yeah, you've got a few years of cash, so you can hold off.
If you spent down for 6 months to a year of it before you sold out of your moderate or growth buckets to shift the allocations, like who cares?
Yeah. Yeah, you capture when the market's a little bit higher.
Yeah. Yeah.
So, like we were talking about, sequence risk of returns is a pretty big, risk in retirement. Like, how you think this pretty much solves that kind of issue pretty well with the cash?
I mean, there's only one, I'm not sure I'm going to go exactly where you wanted me to, but there's only one period of time in one sector where I saw that this still wouldn't have fixed it. And that was if you were heavily invested in like the NASDAQ in 2000, because it took 16 years for that to recover. And so if you don't at any point sell out on the drop, or if the sunk cost fallacy is so strong and you just keep betting on this index to recover, you would have spent 16 years waiting. And that's, if that was your growth bucket, you might be in trouble.
Yeah. Which is why, at least in that 4 to 10 year bucket, you're more moderate, so you're not going to be really in any sector too much.
Yeah. But that's literally the only, I mean, I'm sure there's others. I mean, I don't know everything.
Yeah. And at the end of the day, if markets were turned down that much, there's only so much anybody could do.
Yeah.
Yeah.
Yeah. But that's the only scenario I've seen where it's like it took a sector that long to come back.
Yeah.
So
is there anything else with the 60-40 4% rule or time horizon money that you'd like to go over? I think that covers just about everything I'm thinking.
All right. Yeah, I think so too. I mean, I can give you examples. I had a client less than $200,000 retire, and by doing this model and replenishing their cash when the market popped up, we have provided a ridiculous amount of income, and that accounts now at like $400,000, $500,000, just by having this mechanism in place and being able to time when you pull money off the market to replenish the cash instead of doing it the way a normal person just sets it up, set it and forget it. Right? That was one of the things that, it's one of the biggest detriments to the way humans operate. Is we like to learn something and just assume everything's going to be that way from there on out. We like to put something in place and not forget about it because we want to devote our energies to somewhere else. When it comes to retirement, I just believe you truly cannot do that. It is very detrimental. Now, if that's a really important thing for you, yeah, you can put your money in an annuity and then you can turn that income on and it's locked in.
Yeah.
And you just got to set it and forget it. And as long as you live within that budget every month, you're fine. And I don't think there's anything wrong with anybody's methodology. It's just what works for you and what's best for you, right? And so I have clients that have enough money that they can put their monies in annuities like that. And they're never spending all the money that those annuities are kicking off.
Yeah.
Right. But yeah. I don't have too many. I don't see too many people in that position.
I was to say, if you got a lot of money, that solves a lot of problems. But
yeah, it's hard
for
to
most people, that's not the case.
No, it just really isn't, right? And so I just really think most people, you need to be actively paying attention. You need to be actively communicating with your advisor. You need to break away from the standard rule book that is really just designed to let the financial advisor not have to really do a lot. Collect a low fee because they're not doing anything anybody else can't do.
Nope.
And really absolve themselves of any responsibility as to your outcome. I put you in a 60-40 portfolio. That's what the rule book told me to do. I set you up a 4% income. That's what the rule book told me to do. And you're broke. Well, not my problem.
Yeah. Yeah. Not much work to do because it's all just automated.
Yeah. Yeah. And I just think it's less effective.
Yeah. And ultimately, this is still just like one piece of the entire puzzle. And so these other videos that we've done and that we will do kind of all play together because you talk about how much money you have when you retire. Well, you look at some like our Roth conversion video and you layer in how Social Security's tax and all this other, money that you might be spending on taxes. If you can reduce your costs there, then it's effectively giving you more money to retire with, which would give you all else equal a higher success rate.
Absolutely.
Yeah.
Absolutely. And so and I think you just hit it on the head, right? You got to just layer, and it stinks because it makes things more complex. But it's just the more you can layer everything onto it, you just increment it, right? Right. What's the saying? Small hinges swing big doors, right? It's just add another hinge, add another hinge, add another hinge. Yeah. So that's all. Well, hope you enjoyed this video today. And what's do we have one already on the docket coming up next?
We got several video topics coming up. A lot of them do with taxation, but also like I think there's a couple cool ones that are should be pretty interesting to watch. Like I think one that I would like to do would be kind of just like the biggest mistakes that people make in retirement.
Oh, that'd be great.
Because I think something like that would be good because it'll cover a lot of these things. It's like whether you're doing them or not doing them, and how they can make a negative impact on your retirement.
Yeah. Not watching our videos, number one.
Exactly. That'll be on the list.
Just kidding. But yeah, awesome. Sweet. Well, and they're not meant to be watched in any particular order.
Yeah, these are all just evergreen. So it's just, watch them in whatever order. And I think each one of them has their own value and they ultimately all tie into one bigger picture.
Yeah. Yeah. Cool. Well, thanks, Nathaniel. Guys, until next time, this is Elliot.
Nathaniel.
Signing off.